Hi everyone, I'm Andrew Murphy, the Co-Chief Investment Officer from Winthrop Wealth. In today's video, I'll recap some of the major financial events of the past year and go over our outlook and portfolio positioning as we move into 2021. Most asset classes ended the year at record levels. And while we're certainly pleased with how the markets performed this year, I think we can all agree that we're happy 2020 is over. So on behalf of everyone here at Winthrop Wealth, we hope that you and your families had a great holiday season, and we wish you continued health and happiness in the new year. As always, please reach out to us if you need anything, and we look forward to speaking with you soon. In today's video, we'll cover the U.S. equity and fixed income markets, provide an update on what the Fed has accomplished this year. We'll look at the latest fiscal stimulus package, and check in on the economy before we move to our outlook. So let's start with the U.S. equity market. The S&P 500 increased by 12.1% in the fourth quarter and ended the year higher by 18.4%. The market reached a new all-time high on New Year's Eve when the S&P closed at 3756. And as we've done in the past, we will continue to highlight that 2020 was a roller coaster year, as the S&P 500 fell by nearly 34% from February 19th to March 23rd, before increasing by over 70% since then. During the sell-off, not many investors were predicting that the U.S. equity market would finish positive for the year, let alone end up higher by double digits at a new all-time high. And this is just another example of the power of maintaining a long-term investment viewpoint. The market rally since March was driven by progress on COVID treatments, accommodative monetary policy, fiscal stimulus, optimism on vaccines, and the reopening of the economy. This is a chart of the U.S. fixed income markets with the Bloomberg Barclays U.S. Aggregate Bond Index, or the AGG, in blue, and the 10-year Treasury yield in orange. And as you can see from the chart, bond prices move inversely to yields. The AGG, which acts as a proxy for the investment-grade bond market, increased by 0.7% in the fourth quarter and finished the year up by 7.5%. The 10-year Treasury started the year at 1.92% before falling to an all-time low of 51 basis points, or 0.51% in August, and ending the year at 0.91%. Now this is a chart of the U.S. Treasury yield curve, and while interest rates have moved up some in the last few months, yields are still at historically low levels, with a 3-month Treasury at 0.06%, the 10-year at 0.91%, and the 30-year at 1.64%. And we also wanted to put the current low yield environment in context. Interest rates are still well below where they were 2 years ago and 20 years ago. And now we'll check in on the Fed. In response to the pandemic, the Fed has established the most accommodative monetary policy environment in United States history. The Fed has acted in 3 main ways: lowering interest rates, restarting their quantitative easing program, and creating 13 emergency lending facilities. You can see from the following chart that the federal funds rate is now at a range of 0% to 0.25%, and the Fed's programs this year have increased their balance sheet from $4 trillion to over $7 trillion. The Fed does deserve a significant amount of credit for the returns in most asset classes this year. Fed's policies have helped aid the economy, lower interest rates, calm credit markets, and boost equity prices. And going forward, the Fed remains committed to using their full range of tools to support the economy for as long as needed. And please see our client question of the month on the Fed, which details the key entities and the impact that monetary policy has on the economy, interest rates, and stock prices. Congress was finally able to pass an additional $900 billion fiscal stimulus package, worth about 4% of GDP, in late December. Stimulus package includes aid to households, businesses, and schools, as well as increased funding for testing and vaccines. We do expect that this bill will provide a boost to the economy in 2021, and that the new Congress will immediately begin negotiating another stimulus deal. The United States entered into an economic recession in February, but the economy also likely bottomed at some point in April and has been recovering since. Going forward, the magnitude of reopening, consumer activity, and the recovery in the labor market will vary based on the prevalence of COVID-19 cases and the vaccine. Next year's GDP estimate of 4.2% is heavily dependent on a successful vaccine rollout. And with that, let's get to our outlook. Our market outlook is typically based on four segments: monetary policy, economic growth, corporate earnings, and valuation. In the current period, we added data on the coronavirus and fiscal stimulus to help shape our viewpoint. Going forward, there is reason for long-term optimism, as the market will remain supported by accommodative monetary policy and accelerating corporate and economic growth driven by the vaccine rollout and the recently announced fiscal stimulus package. However, a short-term pause or pullback would not surprise us, given that valuations are stretched and there are definite signs of froth. This chart shows the valuation, or forward price to earnings multiple of the S&P 500, and you can see the current level is well above its 25-year average, as displayed by the red line, and is at its highest point since the tech bubble of the late 1990s. I'll also point out that a market pullback is common and should not really be a major cause for concern, given that since 1928, the S&P has averaged a total annualized return of 9.6%, despite averaging a peak-to-trough decline of nearly 16% each year. So we know that the stock market increases over time and that declines are quite common. Furthermore, the market will remain sensitive to key risks, including the continued spread of COVID-19, any issues with the vaccine, including the distribution, the relationship between the US and China, and the upcoming Georgia Senate elections. So putting this all together, we're moving into 2021 with a measured approach, meaning that portfolio allocations are neutral to slightly underweight as we trim some equities and locked in gains while the stock market rallied to new highs in the latter half of the year. Our investment process really favors trimming on strength and buying on weakness, rather than just chasing the latest outperforming asset class, which, in our opinion, creates unnecessary portfolio turnover and volatility. On the equity side, we remain tilted toward high-quality US stocks, and on the fixed income side, we continue to focus on achieving balanced stability in income while accounting for short-term cash flow needs. And as always, we will utilize our time-tested investment process based on risk management, asset allocation, and security selection as we monitor new developments and utilize any volatility as an opportunity to reposition portfolios. The full written version of our 2020 market review and outlook is available on our website at winthropwealth.com. Also, please check out some of our most recent market commentaries, including our favorite charts of 2020, our post-election piece, and a primer on the federal debt. Thank you for watching our video, and we look forward to speaking with you again soon.